The first half of 2020 certainly has been a nutty strut, to say the least, when it comes to the markets and the global economy. And the question, of course, is now what is the second half going to look like, and where are the opportunities going to be? So I want to take a few minutes to walk you guys through our latest thoughts on this, and also then more specifically looking at just July and August in terms of what the opportunities might be from the trading and the investing side as well. So let's get started with this. We're going to start off with some macro things, and then look at some charts, and really hopefully help you paint a very nice picture. So in order to start off, let me just get right to a chart that I think says a lot, and that's this chart here, which essentially what it takes the S&P 500 performance since 1990, sort of averages it out, and the part you want to focus on is this gray zone. That gray zone represents June through, you can see, about the end of August. And typically, and again, this is an average chart, right? So you could see certainly deviations from this. But typically what we tend to see is June holds up pretty well, then you tend to see some sort of a sell-off, and then maybe another rally. But really, for the most part, you have a pretty choppy and kind of range-bound market. And we actually think that that has a good chance of applying again this year, not only from a historical perspective, of course, but also due to various things that we're going to walk you guys through. So from a trading perspective, we really think that the upside in terms of equities is very, very limited. There's going to be opportunity, maybe shorting on rallies or selling options premium in the upside, but also the downside might be quite limited as well. So we might have a fairly range-bound market, but again, that does not mean there's no opportunity. In fact, there may be a ton of opportunity with this. So let me move on to a few other charts, and this is no particular order, but let me walk you guys through and just kind of show you what some of the important charts out there look like. We're going to get to the NASDAQ 100 in a minute, but I wanted to quickly bring this up, and I think a lot of people are just not aware of this. This is the equally weighted S&P 500 ETF. It's the RSP is the ticker symbol. And if you look at this on a multi-year lens, and you look at this on a weekly chart as we did, you can see that for the most part, we essentially have done absolutely nothing. So the equally weighted S&P 500 is essentially treading water and is no longer in a bull market, right? It's not in a bear market per se, but it's definitely not in a strong bull market because, yes, we're overshot and we undershot, but for the most part, since January 2018, this index has done nothing. And that, of course, gets us to, some of the more troubling things that are happening out there. And I'm going to try to take this in some sort of an order that makes sense to most people. So we're going to, I guess, go right to the NASDAQ 100, which is where a lot of the froth is right now. Not because these are bad companies, but because this is just a lot of focus from a passive investing perspective. So right now, if you look at these charts, and there's a lot of stuff, you don't have to necessarily look at the whole thing. But right now, the FANG stocks, which you guys all probably know what they are, FANG with M as well. I guess that's probably Microsoft. Represents 24% of the entire S&P 500 market cap. So that is a very, very big chunk. Now, of course, you could argue and say, all right, well, these are big companies. They're important companies, ever more so in a stay-at-home economy. And that's true. But the trouble is that you could do a similar kind of chart in volume, and all the volume is focused on just a few stocks, and that usually is not a very good sign going forward. So before we go into a very, very important chart on the NASDAQ 100, and more specifically ultimately on Apple, I want to just quickly take a moment, because it is that time of the year again, to talk about the Wealth 365 online summit. It is by far the best online summit when it comes to trading and investing. I will once again be speaking there as well on a particular strategy that I think is vital to use in any market environment, particularly in this market environment, and certainly as it relates to July, August, and this kind of potentially range-bound market. It's a free event. There's going to be tons of speakers. You're getting a lot of free stuff as well. So I will be there. I'll be speaking. I will be listening in as well, and I learned something every single time I joined the event. So if it wasn't a good event, I wouldn't be speaking and I wouldn't be participating. So I really truly mean that as a Class A event. You're going to learn a ton of different stuff from different speakers, different strategies, different views. So Wealth 365, sign up here as quickly as you can. and I look forward to seeing you guys there. But having said all that, and the link, by the way, is down below in the comment section, or if you got this by email, it's in an email as well. So let's have a look at the NASDAQ 100, and there's a couple of ways we can look at this. So one way of looking at it is with this chart that I crafted here, and this just kind of shows you the longer term perspective of the NASDAQ 100 going back to 2007 or 8, thereabouts. And you can see that the rally is increasingly steep. So that's always a problem for me when I see that. And really, and I wrote this here with some annotations. What you're seeing here in the latest leg of the rally is what I consider to be very dangerous. And what you have is free government money by way of stimulus checks, right? And we know for a fact that across demographics, a lot of people have been putting those stimulus checks into the stock market, even people that have never traded before. It doesn't make them bad people at all, but it makes them people with very little experience at very lofty levels in the market. On top of that, you have no commission broker apps like on your phone that allow you to basically trade for free. Now, how much analysis you can do on an app itself is very limited, basically, to say the very least. And of course, you only need to know 6 stocks. You need to know the Apples, the Facebooks, and a couple more, and you could technically make money if things go higher. But it's getting very, very frothy. And just to give you an idea of what, for example, Apple looks like right now on the weekly chart, let me just peel it back, and you can see this is the long-term trend. We've gone from a steep slope parabolic. We're now at the very upper end of that parabolic move. And so far, last week, we had a clear buyer exhaustion candle. So we'll see what this looks like going into July. Want to quickly sidebar and look at a couple of sort of bigger picture things that don't necessarily mean that stocks have to fall apart, but do, I think kind of help put things in perspective in terms of why I think we could see a very range-bound market. This is an interesting statistic I came across yesterday. It says, and the headline is a little bit deceiving. It says about half of the U.S. population is jobless. So that's the headline, and it's not really what it means. Of course, a lot of people simply aren't working, right? They don't want to work, they're retired. But still, if you look at this statistic, you can see that it's been a long time since we had these kind of numbers. In fact, I'm not sure if you go back past 1950, of course, I don't know what it looks like, but, so a lot of people are not working. People either have given up looking for work, and of course, you have a lot of people get retiring, and that's a problem in and of itself as well. So this is a problem, and just kind of keep that in mind. So I think a V-shaped recovery is very, very, very difficult to come by. Then you look at something like this, which is something that I think from a valuation perspective is interesting. So what you want to focus on here is that blue line. The blue line is essentially the projected profit margins of the S&P 500 versus what the S&P 500 is actually doing. That's the white line. There's a big divergence, and usually these things more or less go up and down together in tandem, but right now there's a huge divergence as the profit margins, projected profit margins are collapsing, but price in the S&P continues to rebound. So again, something there is going to probably reconnect, and I wouldn't be surprised if that happens sooner rather than later this summer. Moving on, another way of looking at things in terms of not believing in a V-shaped recovery, which is our base case, is something like this. And a lot of people talk about, we just need to reopen the economy and everyone's going to be back at work. They won't be, and here's why. Because you can see, for example, this is a statistic I came across yesterday, and this essentially what this looks like is companies like, I think it's mostly shopping, retail, restaurants. Well, you can see it here. And some of these are on Yelp, which is an app. And you can see that, for example, looking at shopping and retail, 35% of companies have closed permanently, not temporarily, permanently. Or restaurants, 53%, right? So this is a problem, and these are jobs that are not going to come back immediately. So I don't know how you can get a consumer or a consumer spending or spending-oriented economy. 70% or so of GDP is consumer spending. I don't know how you can get that back with unemployment not going back anytime soon to where it was. Unemployment rates go back to the recent highs. Give you an idea of what the Russell 2000 looks like. This is the Russell 2000 since 2009. Not much to say here, but you can see a very simple line, and all we're doing is coming back to what used to be broken, what used to be support may now become resistance. And two more charts. First of all, for those of you guys that are a bit more near-term technically oriented, on the SPY ETF, we still have this what's called an island reversal pattern. This chart is now, I think, a couple weeks old, but you can or maybe a few days old, and you can see we still have that up gap on, I believe, June 5th, followed by down gap a few days later, June 11th or so. So there's still that overhead supply, and that for the time being could act as resistance in the markets. And lastly, some of the things that we do really like: gold and silver, and particularly the miners, gold miners and silver miners. And you can see that we might have an opportunity to see some of these silver mining stocks. SILJ is an ETF that you want to keep on your radar, could start to play up with gold miners. And by the way, I'll leave you with the, I wasn't really planning on this, but I'll leave you with the gold miners chart. We just actually initiated a buy trade alert on gold yesterday, actually, for our members. And this is what gold miners look like in their absolute weekly chart. You could look at the daily chart, which looks pretty promising as well, and advancers, decliners are great. There's a lot of good things happening here. So anyway, folks, I hope this has been helpful and kind of what we're looking at ahead for the next several months. Again, I would love to see you guys in Wealth 365. Again, it's to me by far the best online summit that's out there for traders and investors. A lot of great stuff, a lot of great information. So look forward to seeing you guys there, and we'll talk to you soon.